economists that your discipline has failed because of the financial crisis. How can you argue that what you study is valid if you fail to predict, you fail to deal with a financial crisis? And as we'll see later, the Bank of England and Sir Mervyn King, there's a lot of failures, and there's a lot we can criticise that are directly to do with Mervyn King. So that's what I hope I will just outline to us, the areas that we can criticise and the areas we can focus on. So basically, I don't want to spend too much time talking about the financial crisis and what happened, but you have to realise that the magnitude of this crisis was huge. So in the last 30 years, we'd probably say there's only been 3 events that match the sort of how severe the financial crisis was. So we'd say the depression in the 1930s, we'd say Japan's liquidity crisis in the 90s, and we'd say the Great Recession now. So those 3 things are the biggest events in the last 8 years when it comes to financial crisis. Okay, basically I want to talk about economics and how central bankers and how policymakers think about monetary policy. Because to them, before the crisis, there was this unwritten code that was universally agreed upon. So this is called classical synthesis. It's what every single central banker, every single academic economist agreed upon as the sort of underlying principles for the science of monetary policy. Now, if you think about that, should central bankers, should policymakers have such a rigid approach to something that's so, number one, unpredictable, number one, unscientific? So you're saying you're trying to build up a model out of something that's so, because it's easy for subjects like physics to build up models because they're dealing with physical quantities. But if you're dealing with something like the financial environment, you're not dealing with the same certainties. So the biggest criticism I have personally against this sort of synthesis, this sort of agreed upon system, is that you're modelling something that's so unpredictable, number one, and you're really setting yourself up to fail, because as they did, some of these underlying principles came under attack following the crisis. So they're very basic principles, and I just want to spend some time going through them. Wait a second. Okay, these are the basic principles. Oh no, they're not. Okay, those are the basic principles. I have them up. Okay. Those are the basic principles. If you came to Redmond's talk, you know the significance of the first title, which is inflation is always and everywhere monetary phenomenon. And that is what Friedman said. So basically he's saying that inflation is always caused by money growth. Inflation is always caused by too much money in the economy. That's simple. And that's an idea that's sort of developed. You can say that, although I was criticizing them, saying that this science is static, this science, you're building a model, you're sticking with it. This model has changed over the years. So when we saw Keynes' seminal work in the 50s and the 60s on sort of fiscal policy, was the idea of monetary policy as being a strong tool to deal with the economy sort of deteriorated. And it's only when Friedman came along with, I don't want to repeat Tom's lecture, but it's only when Friedman came along with monetarism and the sort of ideas of money being the sole reason for inflation. So that's quite an important idea to central bankers, because it means that if inflation is a monetary phenomenon, who's in charge of monetary policy? Central bankers. So the central banks, a very big part of this model is that the central banks are 100% responsible for inflation. So that's quite important. Price stability has important benefits. Basically, we all do this in GCSE economics. It's just basically saying the costs of inflation are severe. So the cost of inflation distorts the economy as a whole. That's agreed upon. And the third one, there's no long-run trade-off between inflation and unemployment. How many of you, Phillips curve? We've all sort of familiar with it, okay. But I know you're not familiar with the Phillips curve because you don't do economics, do you? No. And the Phillips curve basically argues that there's a long-run, look at you, rolling your eyes, there's a long-run trade-off between inflation and unemployment. I won't go into detail with that too much because it's not worth really going into, but that's basically, for those of you who do know, the Phillips curve was disproved in the last few years. And also, this is really, really important as part of the thought process, the management of expectations. That's really, really complex, but in the 1970s, the work of people like Robert Lucas, who's an American economist, on rational expectations, you're basically saying that a very important tool of monetary policy, a very important sort of element of monetary policy is a management of expectations. So it doesn't matter it matters what you do, but the results depend on the effects you have on the expectations of consumers. So the expectations of inflation in the future, the expectations of future interest rates, the expectations of future growth, their expectations are important, and the effects of their expectations basically dictate the effects of monetary policy. So just hold on, I just wanted you to hold on to these basic principles for now, before we start talking about have they changed, have they been destroyed. So, can someone please read this? Who's going to read? Emma, read. Can you please read Paul Krugman's quote?
Okay, we are already, however, well into the realm of what I call depression economics. By that I mean a state of affairs like that of the 1930s, in which the usual tools of monetary policy, above all the Federal Reserve's abilities to pump up the economy by cutting interest rates, lost all traction.
Okay, this is basically, I just want you to get an idea of how monetary policy dealt with the financial crisis. I'm just going to skip ahead a bit and go to start with the Bank of England. Okay, I just want to focus on how the Bank of England dealt with the crisis, because most people would say that they dealt with it poorly, early on, very poorly early on, because number one, Mervyn King didn't respond to the sort of financial, he didn't respond to the sort of financial developments that had gone on before the crisis. He was quite, the central role of a central bank is acting as a lender of last resort. And when Northern Rock collapsed in 2007, the institutions weren't there to deal with that. And when you look at the reactions of places like America with the Fed, when you look at reactions of European Central Bank, they had institutions already in place to deal with a crisis. And so it makes you think, what was different about the Bank of England? Why weren't we ready to deal with a crisis? And why weren't we ready early on to deal with a collapse of one of the key institutions, Northern Rock? And this is really important. It was hopelessly confused about its legal powers and constraints. I mean, I could have gone into so many quotes that Mervyn King said, but now you think back and you think, was he sure about the powers of the Bank of England, and was he sure about how controlled he was? Because I don't know the date the Northern Rock was nationalised, but he was uncertain about the sort of support that the government could give Northern Rock when legally there was a lot of support available. So number one, you're not prepared to deal with a crisis, and number two, you don't understand the full powers of the Bank of England and the full constraints. So you could say then, a crisis necessary, because without a crisis, the central bank wouldn't have developed and wouldn't have developed these institutions. So without a crisis, where would we be? I want to focus on Mervyn King, because this is just funny now, because I think yesterday or the day before, new inflation figures came out, 5.2%, and this is Mervyn King saying in May 2008, it's good reason to expect that the period we're experiencing of above target inflation to be temporary. Now, it's been 3 years since he said that, and inflation is now at 5.2%. So what sort of idea, what is his idea of sort of short run? So number one, if I had a question for him, I'd ask him, you said this in May 2008, is this your idea of a short run? This is September 2011, we have the highest inflation in 3 years. Well, where are you getting this from? Because every single time, I remember an era, every single letter he wrote to the Chancellor and he explained inflation. He basically said, oil is rising there, food is rising there, so this is going to be temporary, very soon inflation will go back to normal. But this is September 2011, we still have this problem. And also another problem with Mervyn King during the financial crisis was the sort of language he used to address the public, the sort of language he used to explain what was going on. It was wrong, basically. The sort of language he was using showed that, sort of suggested he didn't fully appreciate, number one, what was going on, or fully grasp the severity of the situation. He didn't use, to not use, considering the crisis started about in the middle bits of 2007, to not use the words liquidity crisis, to not use the word credit crunch, or words of that sort of form. To not use those words till March 2008. It shows something quite powerful. Are you not prepared to say that, or are you holding back, or do you simply not know exactly what is going on? So now, and even to yesterday, he used the word solvency problem. I'm not going to go into what that is exactly because that's quite boring. But it's not a solvency problem. It's not a solvency crisis. It's a liquidity crisis. And he's still using words like that. Is he lying? I don't know what is it? Is he lying to us, or is he not fully grasping the situation? So that's just highlighting some possible criticism to Mervyn King and the Bank of England during the crisis. Okay, just basically, these are just, in case you were wondering sort of vocabulary I'm using, what it means exactly. Liquidity crisis, it disrupts the flow of credit, and shocks interfere with sort of information moving through the system. So it's here's a good way to think about it. So when I put X, because there was no down button on the computer, so I put X as sort of an arrow going down. So financial crisis leads to lending going down, economic activity, consumption and investment going down, uncertainty and Y is going up, uncertainty in valuing assets going up. So the financial crisis worsens. This is quite simple, don't you think? Don't you think this is quite a simple way of thinking about the economy? And when you think about, I talk about the basic principles of central bankers. They couldn't see this very simple adverse feedback loop, because the models they used to sort of study the macroeconomy was linear. I won't go into that, because again, that's quite boring. Bit like that, because that's sort of massive. But that's quite, the sort of models they used was linear. And this is a very non-linear system, because what characterizes a non-linear system is sort of adverse feedback loops like this. So if we can sit here and say, accept this as something quite simple, nothing too complicated, why wasn't this built into the models and how they were thought about the monetary policy and how they thought about financial systems? So this was missing in their models and how they thought about, and this is one of the biggest things that came out of the crisis. Okay. I guess you could do, and I'm sort of throwing random ideas at you. It might not seem very structured, but I'm just trying to get you thinking about these things. I just want to offer a defense of monetary policy, because people could argue that what if aggressive policy wasn't pursued? If aggressive policy wasn't pursued, the recession would be worse. That's quite cool. So that's sort of a defense of monetary policy, and I want to. Okay, so I wanted to focus on this, but I didn't have the copies of it, so there's no point. So lessons learned from the crisis. Number one, I'm just going back to those basic principles I talked about. I talked about the basic principles: inflation is bad, price stability is good. One huge thing that wasn't appreciated by central banks was the importance of the financial sector, and the importance of financial disruptions and just small shocks. And this was sort of, because the biggest focus for a central bank is obviously price stability, output stability, and things like that. And that sort of disguises what's actually going on in the financial sector. Because even when you had bubbles and bursts, you had the dot-com bubbles, price was still stable, output was still stable. So focusing on price, not paying close attention to the financial sector, really cost a lot, was really detrimental to sort of the effect of a crisis and how they dealt with the crisis. So this is one of the biggest things I think they missed out. What's going on in the financial sector happens. It's not just what's going on in the whole, what's going on inside. How is capital moving between banks? What's going on? Microstructures of the financial system rather than macro structures. This is quite important because, I said, central banks focus on macroeconomic stability. That sort of disguises what's actually going on, because we've had what we call, before the crisis, it's known as the Great Moderation era, when output was stable and price was stable. So for a central bank, we're doing well. We're not dealing with what, the developments in the financial system. but to them, they're doing well. A bubble burst, they cleans it up. What English is that? A bubble burst, they clean it up, they move on, they stabilize prices. A bubble burst, they clean it up, they move on, they stabilize prices. So as long as prices were stable, these sort of financial imbalances were building up, and they were ignoring it, basically. I mean, and Alan Greenspan is he's a really interesting, Paul Krugman's actually more interesting. But I just talked about the whole bubbles bursting, cleaning up. A huge development for the financial crisis was in the lean v clean debate. So it's basically, how do central banks deal with bubbles? And because the whole crisis was caused by the housing bubble. So how do central banks deal with bubbles? In that debate, I just want you to quickly listen to this better word.
No one person is responsible for this crisis. But if there's a single person you might want to put in stocks and have people throw rotten apples at, it would be Alan Greenspan. Mostly because he, more than anyone, could have done something to at least diminish the scale of this thing. There was, as this housing bubble was building, it was the clearest bubble I've ever seen economically. But he insisted that there was none. He was warned specifically about subprime lending by members of the Board of Governors, and he refused to do anything about it. He stood against any kind of regulation. He assured people that financial derivatives had made the system much more secure. And in all of these ways, he helped to block. There was nothing precautionary was going to be done as long as Alan Greenspan was both assuring everybody that things were fine and, to the extent that it was actually his authority, refusing to take any action. And so I suspect that no matter who was there, we would have had something like this. There was probably going to be a crisis, but it wouldn't have been as big, it wouldn't have been as devastating without Greenspan.
I think that's just important to think about, because the reason he's pointing to Greenspan is because I talked about the lean v clean debate. There's an argument whether if a bubble is developing, should a central bank step in and prick that bubble by raising interest rates, or should they just leave it and clean up afterwards? Mervyn King, Greenspan, their approach was that, well, not Mervyn King so much because he hasn't had the same sort of time span as Greenspan, but Greenspan's approach was to let the bubbles burst and clean up afterwards, the mopping up approach. So a huge development after the crisis was, this is wrong, because you can't, bubbles aren't obvious, but as Krugman is saying there, we could probably have seen it, if it was in front of us, we could have seen the sort of, housing bubble, what was going on there. But maybe not seen, okay, this is huge, it's going to cause a crisis, but see, this is something worth, looking at. And that's a really big thing. The central bankers did not pay sufficient enough attention to what was going on in the financial system. Okay, we've talked about macroeconomy being highly non-linear in the fact that they miss out, models before the crisis miss out this sort of idea of a feedback loop. So we've talked about that. That's what I meant by the macroeconomy is highly non-linear and swings in. But this is important as well, because zero low bound problem is basically where monetary policy is powerless, where rates are zero and monetary policy is basically powerless. And before the crisis, this was seen as a problem of only historical relevance. But this was realised to be a huge problem. But for central bankers, the arrogant people, this actually helped their portfolio, because although a conventional instrument wasn't working, and the interest rates weren't working anymore, unconventional instruments like quantitative easing and other financial instruments, those started to work. They claim that those instruments worked, but the zero low bound problem, the fact that once you get to zero rates, says monetary policy powerless, that problem became, it rose in significance and how people think about it. It is a problem worth dealing with because Japan in the 1990s, because they didn't deal with it well, it cost them a lot when it comes to output, when it comes to growth, when it comes to their general economic prosperity. It cost them significantly. I think this is really important because, when I had my interview with Dr. Baxter for an Oxford mock interview, the first question he asked me was, do you think your discipline has failed, or do you think economists have failed because they didn't predict the financial crisis? That's what I say, that's quite an easy question just to try and interrogate an economist. And I think this is important because what people say is that no one saw it coming, but people did see it coming. Some people did try and raise alarm bells. And if you read, I didn't read IMF minutes, but I read an article where it shows that any sort of anti-consensus views were put in final drafts of minutes that were given to policymakers. So anything that said, hold on, we should look at this, hold on, maybe this isn't the best thing to do. Anything that went against consensus views was sort of muted. So I think that's really important. What's the sort of spectrum of views are policymakers and people like Mervyn King, what's the spectrum of views he's available to? Is he only available to yes men and consensus thinkers, or is he also available to people who are willing to say, no, look at this? Oh, and number one, are people like Mervyn King doing enough to look for and to look for logical inconsistencies, to look for imbalances? Are they doing enough to look for those things? I think that's really, really important to ask people like Mervyn. What are you doing to make sure that you're getting a broad spectrum of views? Because me standing here, why didn't someone see this coming? That's the biggest question. But when you actually look at it, some people did see it coming. So the better question is, why weren't they listened to? Why weren't they able to reach sort of mainstream views? Reach policymakers. And coming back to the initial question, the title of this is sort of misleading because so many people will argue that the science isn't destroyed. But I think that's quite important because those people, I've read a fantastically argued article by an economist who's arguing nothing's changed, the fundamentals of the science are still the same. But if you're coming from a crisis, and a crisis that has caused us so much, if the fundamentals, you're arguing, if those underlying principles of your discipline, if they are still the same, does it mean that, yes, our science is right? Or does it mean that we need to rethink those fundamentals? Or does it mean that we need to rethink those things, the principles we see as underlying principles? I think the latter conclusion is correct. Because just because you're saying, because coming out of the financial crisis, there's no way you can say that we've won. There's no victory here. So, if you keep arguing that the fundamentals of your science are correct, you need to rethink it. You need to rethink those fundamentals. Because if those fundamentals aren't predicting or dealing with crisis, why are they there? What are they there for? To just, I think they're useless. But again, some critics call for a total rethink. But that's not really valid, because if things like inflation is a monetary phenomenon, that's still the same. Price stability is still important. But it's just what a central banker looks at. I think this is quite important to ask Mervyn. How is your own thinking, how you do your job every day change because of the financial crisis? Because is he and his team, are they paying closer attention to what's going on in the financial sector? Are they making sure that they get a broad spectrum of views? Do they fully understand that the macroeconomy is non-linear? So these are the sorts of things we need to say, King, are you doing these things? Are you ticking these boxes? We don't call him King, but yeah. Oh yeah, I've spoken about this. Let me just... I think these are the three key lessons from the crisis, I think, that okay. I think that's... I think I've missed something. No? So are there any thoughts to this before I just move on? Are there any thoughts about, so if, okay, pretend, what would you ask Mervyn King today if you saw it? And, because you must have thought of questions that you say, when you come, I'm going to ask him this, you must have thought of something, even if it was, yeah.